Welcome back to the Home Equity Partner presentation. This is the second video in the series, helping average people do extraordinary things. And the most extraordinary thing is paying your mortgage off in under 10 years without contributing any money out of your pocket. Now, the information presented here is of a general nature. It's for educational purposes only. There is no tax, accounting or legal advice offered. If you seek that advice, then get the services of a licensed securities dealer. During your life, you'll make investments. Most people invest some money into the stock market, if not directly, then through their retirement funds. A few braver souls venture into things like commodities and foreign exchange, but what most people end up doing is they invest in a home. It is the biggest single investment that people make in their entire life, and they also borrow more money when they buy their home than what they've ever earned up to that point in time. They then spend the rest of their life paying the mortgage off, and the result is millions of families end up drowning in debt. This could be seen throughout the world following the GFC, the global financial crisis, where markets melted down. And in America, there were more than 10 million American homes that went into foreclosure. Now, you go to school, you learn a few things, and if you're smart and you're going to invest in the stock market or commodities or forex, you'll take a course or two to learn about what you're doing. But how many people actually do any courses in investment or finance before they buy a home? You don't need a license, in fact, to buy a home. Anyone can go off and do that with no educational qualifications, and as a consequence, few people ever learn how to manage their mortgage before they go off and they borrow hundreds of thousands of dollars. They're not professional money managers. They certainly don't have much of a chance of getting it right, and that's why 10 million American families went out the back door. Now, the way to make money is through investments. Savings is just not going to cut it, because you have a look at what the average budget is for a household. Very few households are actually saving money at all, and the only way they can get ahead is through investments. The difficulty is they don't have money to invest. Now, having money to invest is the key, and the paradox is you can get money by borrowing money and investing it pretty much in the same way as you did when you bought your home. But to start with, you actually have to increase your debt in order to retire your debt. The way we reduce your debt is through investing in real estate. Let's say your home's worth, say, 550 grand, and you got a mortgage on it of 250 grand. Your objective is to pay that home loan off in rapid time. One way of doing it is just to have a look at how you're managing your money and your assets at the present time. Let's say the annual payments, your interest or your mortgage payments, which are generally principal and interest, is $20,000 a year. It's going to take you 30 years of paying that. In Australia, the interest is not tax deductible, whereas in America it is. So there's a significant benefit that Americans have. Now let's assume that you have some spare cash. I know this is sort of an unlikely situation, but this is how the program originated in Australia when I first introduced it. It's the concept you need to understand. You don't need the 20 grand in shares. But let's say you had 20 grand in shares. The smart thing to do is to cash them out. because there's no guarantee on what those shares are going to give you. You're getting no tax deduction on having those shares, and it's costing you money here in your mortgage. If you cash out $20,000 and pay it down on your mortgage, you reduce your debt by the $20,000. You're actually saving whatever the interest rate is, whether it's 4, 5, 6% per annum. It's a guaranteed return because you're not paying money that you've actually contracted to pay, and it's also tax-free. You don't actually pay tax on the money you save. Now, as I explained earlier, the key to getting rid of your mortgage entirely is through investing, and what you do need to do is actually borrow money to invest. But if you borrow money to invest, let's say you borrowed the 20 grand and you put it back into the share market, you're then getting an interest deduction on that investment account. Whereas if you just had your shares that you started with and you didn't borrow to get them, there's no investment loan, so there's no deduction that you're getting for that amount of your mortgage. Now, if you add the two accounts, the mortgage account and what you borrowed for an investment, you see it totals $250,000. That's the same amount of debt that you started with. You didn't increase your debt by 1 cent. It's just that you've created a deduction for the interest on your shares, which you weren't getting before. Now, investing in shares has a lot more risk than investing in real estate, so what we prefer to do is to concentrate on investing in real estate. And here's how it works. Here's your house, $550,000, $250,000 mortgage, costing you $20,000 a year in payments. We need to establish an investment, and let's say you don't have those shares, let's say you have no extra cash, but you do have equity, the amount above the line. You've actually got $300,000 worth of equity. So the thing to do, you borrow some of that equity out and make an investment. It could be into a business, it can be into a company or into shares, and as we intend to do, we put it into an investment property. Now, your investment property could be a $400,000 property or $500,000 property. It just depends on how much equity you have here, how much money you can borrow out against your equity to then put it into the investment property, and you then need to borrow the funds that are short for that investment property. Now, let's say we make an investment of $400,000 into an investment home. We only need about $100,000 in this example to put down as a deposit on that property, and we can then borrow $300,000 for the investment. So altogether there's $300,000 borrowed on the investment property, and there's $100,000 borrowed on your home as an equity loan. We have a $400,000 total investment, and let's say the rent is $300 a week. Let's have a look at the cash flow. You have the rental income, and it's close enough to $15,000 a year of income that it generates, and there will be tax credits based on the interest deduction and also on a depreciation allowance. So let's say there's $20,000 comes into you each year from that investment home, but there are outgoings. You have to pay interest on your loan. There's property costs, there's repairs, there's maintenance, there's rates and taxes. And the depreciation is actually a double-edged sword. You can get a tax credit for your depreciation allowance, but that's actually only sort of a temporary item. It actually gets added back when you sell your property. So it's only a tax holiday rather than a permanent benefit. The second thing is, though, depreciation is a real cost when you have a look at maintaining your property. There's repairs and maintenance, and if you don't look after the property and spend money on keeping it in shape, it will actually go down in value. So you get a temporary tax credit for it, but you also need to spend that money just to make sure you maintain the value of your property. So during the year, total outgoings are going to be 26,000. The inflow is only 20,000. There's a shortfall in this example of 6,000. In terms of today's market, the shortfall is a lot bigger than that in most instances, and it's over 10,000 a year, which means about $200 a week instead of, in this example, of $115 a week. Now, whether it's $115 a week or $200 a week, you've just got to say, well, can you afford it? In the budget analysis, which we did in the previous video, you could see that the average family has no savings and they've actually got a debit on their credit card. Now, the process of buying an investment property is done through what's called negative gearing. You have rent, which the tenant pays for. There's a tax credit that comes from the tax man, but there's a shortfall, and that's why it's called negative. You are negative what the difference is, and that's what you have to cover, and that's where the problem is. If you have no savings, you don't have the ability to save, where are you going to meet that cost? Well, this is where we step in, where the home equity partner steps in and actually covers that cost. Now, there's always a risk of investing, whether it's in the stock market, in business, or in property. There's market risk, the interest rates, the economy, and the property market itself. And what's the return that you're likely to get? And is that guaranteed? Well, in most instances, the answers are all negative, right? And if you continue on down through the negativity, you have problems of finding a tenant, whether they're going to help you and look after the property, or they're going to be the tenants from hell. Will they pay the rent you want? And how well located is your property to ensure that you actually can always have a tenant there? The risks continue, and let's have a look at your personal circumstances. What happens if you get injured? What happens if you get fired? If you're out of work, your income stops. And in terms of looking after the properties and your other investments, do you have the time? What's your knowledge and skill? And how well do you think you'll go as an investment manager? If everything works out, you can manage the property, your tenants, and the market's okay, you still have that hole, you still have the negative gearing where you have to make up the difference between what comes in from your investment and what you have to pay out as the shortfall. So what can you do about this? Well, for the average person, they can do very little because they don't have the capacity to save. That's where the home equity partner comes in, and if you qualify to be a partner with us, then we can put you on the Home Equity Accelerator program. Now, we'll show you how it works. There's a gold mine in your backyard, there's also one in your front yard, and if you live in an apartment, it's actually under your floorboards. However, you don't really have the skills and the resources of mining it, and this is where you take in an equity partner and form a joint venture company, and it's the equity partner that will provide the resources, access to funds, the skills, the know-how, and finding a suitable investment that's actually going to help generate the money, the additional money that you'll need to pay your mortgage off. Now, what's involved in the joint venture? Well, there are two partners. There's yourself and there's a home equity partner. The home equity partner will select and manage the investment. They will service and manage your investment debt, They will not pay your normal mortgage, but they will pay all other loans involved in the investment. They'll arrange the finance and they'll assist with the restructuring of your existing home loan so that you can use the hidden equity there buried under your floorboards and in the backyard of your property. You must work to an agreed plan, as too will the home equity partner. It's a joint venture where each does their part. What are you going to do? Well, the most important thing is just maintain your normal monthly mortgage payments, exactly what you're doing at the present time. It's not a matter of increasing the amount of money you put in, and you certainly don't increase the amount of money that you've borrowed. Now, there are benefits that will come as a result of the income from the investment, from the property, the rents, and the tax credits, and all of that income from the property, from the investment, is going to be used in the servicing of the investment debt. So it's important that you actually provide the home equity partner with the benefits that are being created in order to keep servicing the debt. If you don't transfer these benefits into the program, the investment loan will not be able to be serviced. An additional thing we ask each of our customers, our clients, to do is to refer at least one person each year. Now that's 12 months, that's 356 days that you have to send one person. Over the next 10 years, we expect you to send 10 people. Now, if you keep this end of the bargain, you'll actually receive additional income from us. We'll actually put money, extra money, into your mortgage to help accelerate the repayment of your home loan. Now let's have a look at the traditional investment. There's the home with a value of 550k. There's the existing mortgage, which has a debt or has a servicing of $20,000 a year. And we have an investment property that's generating rental income, but not sufficient to cover the investment loans. With the Home Equity Accelerator, the way things work, this is your existing mortgage, $250,000, and you increase your borrowings for investment. We would drag out here a suitable amount to put down as a deposit on your investment property. Now that money goes into a joint venture company, and the funds can be invested in a number of ways. First thing though is we invest into a property. The next thing though is we put money into a company, which is the JV vehicle that helps manage all the investments and the investment loan. And the third thing is, because we've established the company, we have a business now, so that if you refer or when you refer additional people, there'll be added income that will be able to go towards paying off your home loan and accelerate the process. There's a return on the investment, and there's also a return from the bonuses you receive when you refer someone. So the money from the investments and the bonus can get paid down here into your home loan, which will reduce how much you owe, and it can also assist in servicing the investment loans. You'll have tax credits, similarly can go down to reducing your mortgage, and again assist in paying the investment loans. Now you have a part to play in this. In addition to just paying your normal mortgage payments, we'd like you to be an ambassador for our company, and that means you telling people about what you're doing. You set your own hours, work your own pace, and all we want is for you to have one person come in and see us every 12 months. Now, you don't have to stuff envelopes and you don't have to sell anything. All you do is introduce people who have an interest in owning their home in 10 years or less. Now, once you've introduced 3 people, we will actually put $3,300 into your home loan. It's not for you to play with and take out and spend. It is to suppress the amount of debt, the amount you owe on your home loan, to help pay it off more rapidly. Now here's a typical amortization schedule. If you're having trouble with your eyes, as I do, you may not see the numbers too clearly, in which case you can have a look on the internet at amortization schedules and see more clearly. But let's have a look at what's going on here. The annual payment of $20,000, $20,146 in this example, goes on for 30 years, and it's only after the 30th year that you own your home. Now let's have a look at some really nasty things. Let's have a look at 10 years. After 10 years of paying $20,000, if you multiply by 10, you've actually paid $200,000 to the bank. Let's have a look at how much you still owe. You started with a debt up here of $250,000. You've given the bank $200,000 over the first 10-year period, and you still owe $213,000. After a $200,000 payment by you, all you've done is reduce your debt by $37,000. Let's have a look at the situation after 20 years. After 20 years of paying $20,000 a year, you will have paid $400,000 to the bank, and you will still owe $140,000. All you've done is reduce your debt by $110,000, and you've given the bank $400,000. After 30 years, that's when you finally own your home. Now the Home Equity Accelerator does much better. Through managing your investments, we can generate an extra $20,000 a year. We have an alternative as to how we go about it. We can either put the $20,000 that's being generated directly into your mortgage so that your mortgage balance goes down each year, or we can keep all of these 20,000 benefits and invest them and get a return on those as well, so that we'll actually be generating a higher return than what your mortgage interest is. And it really just depends on what sort of investment returns we can get and what the interest rate is on your mortgage as to which alternative is the best approach. But using either approach, the mortgage is going to be paid off in under 10 years. In this example, it's actually by the end of the 9th year. It's certainly far better than going for 30 years. You go for 30 years, $20,000 a year for 30 years is $600,000 you end up paying. In our example here, you go for 10 years, you only pay $200,000. You've also got 20 years where you can be saving $20,000 a year, and that can go towards your retirement. Graphically, it shows you, where you're going at the present time. 30 years, you finally own your mortgage. The alternative is 10 years, and you've got these 20 years where you're going to be saving 20 grand a year. Which do you prefer? You want to stay in your 30-year plan? Or would you like to change to the accelerator? Now, what's it going to cost you? Everyone wants to know, what's it going to cost? Well, there's no upfront cost, right? You're going to make an investment. Yes, money needs to move, and it's going to be borrowed, and there's going to be interest on that money, but your home equity partner is going to look after those expenses. It's a joint venture arrangement. we're not doing this for free. We're going to make money out of the joint venture. That's what joint ventures do. Both parties, both partners make money. We're going to be saving money and we're going to be making money for you. We're going to save money from tax. We're going to make money from the investment, and you don't have to make any of the payments on the investment loans. After 10 years, you won't have to make any mortgage payments on your home loan because you won't owe anything. And if you've done the right thing and referred 10 people over the 10-year period, we'll split the profits, and the split will be 75% of the gain to you and 25% to the home equity partner. If you've referred fewer people, then there'll be an adjustment to the split. Now, after paying your mortgage off in the 10 years, there's another step if you want. It's optional, but we suggest you take it, and that is to move on and to create wealth so that there'll be money there by the time you reach retirement. So after your home loan's extinguished, decide, do you want to make money or do you just want to sit there and save the $20,000 a year? You have the option of starting to create wealth. There's no end fee, and we simply buy more investment properties in the same way as we started and the same way you went about buying your first property. Now you can learn more simply by clicking the link below.